I'm University of Illinois Extension's Todd Gleason. This is a FarmDoc webinar. Today, the One Big Beautiful Bill Act tax changes, strategic planning for farm operations in 2025 and beyond. We're joined by Bob Rhea. He is with Illinois FBFM and a tax specialist. Bob, thank you for being with us. The program is yours.
Very good. Thank you, Todd Gleason, and thank you, Jim Baltz, for producing this event. Jim and Todd are both joining us here today. A pleasure to be with our audience today to talk about, guys, this is one of the biggest things we've seen in the tax code changes that has happened on July the 4th of 2025. It's also very unique that it's happened that early in the year. There was a lot of guesses that there would be new tax legislation and new rules. And there was also concern that those might not happen until really, really late in 2025. The good news is they're here in July. We're already trying to understand them. That gives IRS a chance to tell us more about what they really mean in these legislative pieces. And today we'll comment about some of the highlighted sections of this 800-page bill that affect our farm families and Illinois farm operations and those all across the FarmDoc audience. We begin with a definition of the terms that we're trying to reach. The first term we talk about, we'll be describing today, is the 179 deduction. We put a little detail here on what that exactly means. This is a business deduction for purchases. We'll be talking about a couple different types of 1099s, those that report payments to contractors, as well as those that report payments of interest and cash rents that are paid. And this kind of rarely used 1099K form, how that's new and different. You'll hear us describe AGI, MFJ, TCJA, and QBID. Those things are also described on our screen here about what your adjusted gross income level is. That's all of income minus certain deductions. And from there, we calculate tax liability, again, after a few other deductions too. Married filing joint, I use those in a couple of examples because that's the largest percentage of tax returns are filed as MFJ, but there are a variety of filing statuses available to taxpayers. We'll be talking today about an act called the One Big Beautiful Bill Act, and in general, it replaces, updates, enhances the TCJA, the Tax Cuts and Jobs Act. And Todd, interestingly, that was signed on a Friday afternoon in 2017, the day before the Illinois-Mizzou bragging rights game. I remember that vividly in 2017. We'll talk about QBID, the qualified business income deduction, and all those things are new pieces of this legislation. It's a mouthful, the One Big Beautiful Bill Act. Some people are calling it OBBBA. At the tax school today, we're calling it OBBBA. I'm not sure what word will stick to close out this definition, but it's all under this phrase of HR1, House Resolution number 1. It came in a very unique legislative process. It was introduced many months ago, and actually segments of it had been introduced even a year ago. But on May 22nd, it passed the House. Look at that vote, 215 to 214 on how close that vote was. It then went to the Senate. They debated it. They modified it. They passed it 51 to 50 on July the 1st. And as you follow a parliamentary procedure and rules of the U.S. Senate, the vice president cast the tie-breaking vote to give that a passing measure and move it back to the House. Because there had been changes made, the House had a chance to look at it one more time. They passed it late in the day, July 3rd. 218 to 214, and then finally the president signed it on July 4th. That was, a targeted date set many months ago, as probably even earlier than inauguration in January, but it was set many months ago as a targeted date to make it happen, and it did happen. And as we look at the slide with all of those votes, Todd, I'm thinking about even local school boards, local townships. I'm on a community college board, and votes matter. I mean, look at the difference on how close these votes were. And, the Democratic voting process was really on display here in our country that culminated on July the 4th. But really tight votes. Votes matter no matter if we're in the Congress or we're in your local school board activity. The first thing we'll discuss are some individual provisions, those that affect individual taxpayers. We'll then talk about those that affect business owners. So effective for 2025, the general thing that happened was all of those TCJA, Tax Cuts and Jobs Act provisions, they were all planning to be expiring on December 31, 2025. And that occurs because there are always budget implications of tax bill legislation. And that bill passed in 2017 had certain additional tax benefits to individuals and businesses, which means they increased the cost to the government. And because of that increased cost, many of those had sunset provisions so that they could be debated again and did not have such a long-term effect on the federal deficit. So those were set to expire. We've been wondering about what would happen for a couple of years. And now we learned on July 4th, they generally were extended and a few were also made permanent. And when we describe things being permanent, we're not exactly sure what that means. Certainly not permanent in a long term, but I view that as permanent until the next legislative piece changes it. It doesn't have a sunset provision. It doesn't have an expiration date. They are here until later changed. We have had 7 tax brackets since 2017. Those will continue at 10, 12, 22, 24, 28, 35, and 37. TCJA cut those a little bit. For example, the 22% rate had been 25. The 37% rate had been 39.6. So we've had these lower rates now from 2018 years going forward, and we'll have those for the near-term future until changed. We also received some higher standard deductions, and these are good for 2025. In fact, the higher standard deduction that was in place was still here for 2025, but they raised it a little bit more. For example, the married filing joint, on July the 3rd, we thought that standard deduction was $30,000. And then after the legislation, it went up a little more to $31,500. There is a brand new senior deduction that is in addition to this $31,500 standard deduction for seniors, 65 folks or older per taxpayer. So if you're married filing joint, this will be a new $12,000 deduction if your income is not over the threshold. And for married filing joint, that threshold is $150,000. If you're a single or any other taxpayer, it's $75,000. So the way that kind of works, let's say your AGI is $180,000. You're $30,000 over the threshold, and $30,000 times 6% is $1,800. So your $6,000 deduction goes down $1,800 to $4,200. So many of these provisions have income thresholds and phase out levels. So they're not designed, or let me rephrase that, they're not fully available to people who have incomes at levels above whatever the threshold was established. So this is a brand new thing. Never had it before. It's a new $6,000 per taxpayer deduction. Seniors also get an added deduction for age. That continues. That is about $2,000 for an individual, $1,600 each if you're a married couple. That's still here, but this is a brand new $6,000 item. The child tax credit that has been $2,000 for several years is now bumped up slightly to $2,200. Those are tax credits. That's real money in your pocket if you have a child in your family who's under age 17. The deduction, that's $6,000 per payer. That's not $6,000 in your pocket. That is a $6,000 reduction to your income that saves whatever tax rate you may be in. Interestingly, that is the provision that is kind of touted in the popular press as the no tax on Social Security promise. Well, that's not exactly what happened. There's just an additional deduction for folks age 65 and over. Continuing with individual provisions, this was one of the most hotly contested issues, was a state and local tax deduction. often called the SALT cap. That had never been capped until TCJA. It then was capped at $10,000 per year for a tax return. And that is now bumped up to $40,000, a significant increase as a potential itemized deduction for state income tax, for real estate taxes paid on non-business property. That's a higher deduction that has not existed ever before. Well, I say that, but before TCJ, it was unlimited, but it's the highest cap we've ever had. It also has an income threshold at $500,000, and 30% exceeding that is reducing the SALT cap limit. So let's say your AGI was 600,000, you're 100,000 over, 30% of that 100,000 is 30,000 of a reduction, and your $40,000 available deduction drops back down to 10. So you can see in a couple of these provisions how higher income individuals do not get the full benefit of the announced tax saving provision. No tax on tips was a very popular campaign pledge. It came through the law in the OB3 in a slightly modified way. Up to $25,000 of tips that someone earns can be deducted on their tax return. We think that's going to be a new deduction on this form called Schedule 1. The W-2 will identify how many tips an individual received, and the employer will still report those tips. They'll withhold tax on those tips, and the W-2 will look the same. It's just that individual will be able to take a new deduction for up to $25,000 on tips they earned for the year. There's also a no tax on overtime provision. That's a $12,500 limit. And again, all the earnings by an employee will be reported on their W-2. There will be additional information provided either on the W-2 or on some statement that will let the employee know how much of their earnings came from overtime. In the past, we've only reported those on pay stubs, and now we'll be reporting them also on Form W-2. The employee then can take that deduction on Schedule 1 and lower their overall income. Let's say that's an employee who has no income restrictions and they had total wages of $42,500, of which $12,500 was comprised of overtime. They will get a W-2 that shows $42,500, but they'll only pay tax on $30,000, and they should have a pretty good size refund because they've had withholdings on the full $42,500 in my example, and they'll pay tax on a net of $30,000 of that earnings. Now, a couple of other unique provisions here. We can't modify what we're doing and try to take advantage of these things. So the tips are generally designed for only industries that before 2025 customarily and regularly paid tips. So think about restaurant workers, think about hospitality, think about beauty supply providers. Those kind of personal services often include tips. We'll think about transportation drivers who get tips. Those are customary, regularly paid. They will get to take advantage of this tip provision. But I can't start paying my farm employees in tips and let them get a tax deduction. That's not going to be allowed. IRS is going to publish a list of industries of where tips are customary, and only those industries will be able to utilize this feature. Farm employers will not be on that list, we don't think. They're not going to benefit from the tips. No tax on overtime. This is not as good as it's going to sound either. I'm disappointed a bit to say we don't think any farm employee will take advantage of this piece. There is a rule deep in the regs, and again, this is 800 pages of rules that, by the way, we're still trying to understand and IRS is still trying to interpret. But we're pretty sure that on the overtime rules, if you're in an industry that is not required to pay overtime, you can't start paying overtime and obtain tax deductions. Farm employers in Illinois are not required to pay overtime. Farm employers in Illinois, I don't think are going to be benefiting from overtime deductions for their employee. Jim has a question here. Is no tax on overtime double for MFJ? Can one employee deduct $25,000 if the spouse has no overtime? Yeah, that $25,000 is per employee deduction, I believe. I don't think it's capped on the tax return limit. I think that's a per employee tax deduction. But again, there will be limited industries who can utilize that. And for our farm employers, I don't think we're going to have overtime deductions available either. And many industries will not have qualifying overtime. There's a new passenger car loan interest deduction. It's up to $10,000 of interest paid in a year. And, if we take a $10,000 interest expense, that's a pretty sizable vehicle loan to generate that much car loan interest. It comes with some brand new restrictions as well. One of those is the original use of that vehicle has to begin with that taxpayer. So it sounds like it has to be a new vehicle. This one's kind of odd. Jim, you'll like this. It has to have at least 2 wheels. So I don't know what else we might be having there, but it has to have at least 2 wheels to be eligible for this deduction. And it has a GVW, gross vehicle weight rating, of less than 14,000 pounds. And there has to be a lien provided, and it has to be the original lien provided or the first lien provided on this vehicle. So, this screen provides a lot of added benefits, but also they have a lot of added restrictions for these taxpayers. They're just not always as completely good as they sound initially. But overall, they do provide benefits.
Bob, with no tax on overtime, what if I'm in a state that requires farms to pay overtime? Is it all based on federal exemptions or state exemptions as well?
Yeah, that's a great question. We argued that yesterday for 15 minutes of whether it was the FSLA, the Federal Labor Act, I forget what the S was for, or if it was like in Illinois, it's the Illinois Wage and Hour Act provision. We think if either of those exempts people, then there's no overtime provided. We just happened to look like in California and Oregon, which we think those states' laws are different than Illinois. We don't think overtime provisions are available there either for that subtraction. Fair Labor Standards Act. Yes, I had the acronym backwards. That's right. Fair Labor Standards Act. So I think that's an interpretation we're still waiting to hear about. And I appreciate that question because it lets me say this as well. In our meeting yesterday was a person who's heavily connected with things in DC. He's been there a couple of times last week, going back next week, and they are trying to create frequently asked question lists to answer some of these very specific pieces and deliver to taxpayers and tax professionals relatively soon. Now, those are not always designed to be the highest level of authority and the highest level of governance, but they're better than what we currently have. So we're going to be paying attention for regulations. That'll take a long time for those to come. Notices, we'll have more of those before the end of the year. And frequently asked questions, those will come out as early as August. That will help us interpret some of these provisions to these very specific questions that we know people are still going to have. The law is written, and if you read the 870 pages, a lot of times they take a current provision and say, eliminate this word and add that word. And we don't really see the whole provision rewritten. So there's still a lot of interpretation left to do. Overtime rules is a good example of those that are left. But we're kind of banking on the fact that a lot of farm worker overtime will not be eligible for that provision. And I hope that a rule says I'm wrong about that. Let's move to some business provisions. Bonus depreciation made permanent at 100%. This is a really good thing for our farm clients who are making investments in a variety of depreciable property. This has a very unique start date, January 19th, 2025. Only purchases after then qualify for this full 100% provision. We had that a few times in the last 25 years, most recently in 2018, 19, 21, and then it began to be reduced a little bit. So this year was scheduled to be 40% in 25. It was a 60% number in 24. It was an 80% number in 23, and it was scheduled to go to zero. But now it's back in at the full 100% level. But again, purchases made after January 19th of 2025. What all is in this group? Well, breeding stock is in this group. Farm equipment is in this group. Used farm equipment is in this group. A tile is in this group. Livestock buildings, grain bins, machine sheds are in this group if they're used for a farming activity. This is the broadest group that includes many pieces. Jim says, as a question about tile. Yes, farm tile is in this group. Farm tile is called 15-year property, and bonus depreciation is available for everything up to 20-year property, which is machine sheds for farm use. So a large group of property is eligible for this provision. Taxpayers for 1 year can choose to use the rule that was in effect before and only use 40% if they choose to. And let me contrast that provision with this one, the 179 deduction. This is up to $2.5 million, the highest it's ever been. On July the 3rd, it was $1.25 million as our deduction that had been in place for 2025. It was doubled up to $2.5 million. It has a phase out level. So once my purchases exceed $4 million, I begin to lose this $2.5 million deduction. Let's say my purchases for the year are $4.2 million. Then I lose $200,000 of that $2.5 million. And the biggest deduction I can get under the 179 rules then would be $2.3 million. Well, that's okay because the phase out had been much lower at $3.13 million, which means we lost the 179 deduction much quicker. So we've never had it this high of a level, and we've never had it at this amount of phase out level. So we go all the way to $6.5 million before we lose all of the 179 deduction option. And that had been $4.38 million. That is a big, big difference in changes in how much we can purchase and still rely on that 179 deduction. And remember, these deduction amounts are the total purchase price of an item, not the trade difference. So I have a combine that's worth $100,000. I trade it for a different combine and pay $400,000 in cash. I have to rely on that $500,000 number as the amount that goes into my purchase phase out calculation. One more thing about 179, and I'll get to a question. Notice the placed in service date, very different than bonus. Property placed in service in tax years beginning after December 31, 2024. So if I'm a calendar year taxpayer, I buy something on January 15th of 2025, it's eligible for the larger 179 deduction, but it's not eligible for the 100% bonus provision. What if I'm a fiscal year corporation and my year end is July 31st today? I can use bonus depreciation on everything I've purchased after January 19th, but I can't use the higher 179 deductions until I start making purchases in August. So our fiscal year filers have a unique piece here. They have a delayed implementation. So if you're not a calendar year tax return preparer, be cautious about when these two rules affect the purchases that are made that affect deductions for your business.
There is a follow-up question, as you made note, Bob, about tile. They wonder if it's still eligible for bonus if it was purchased on an existing farm. Could it be depreciated in that 100%? So it's new tile, not quite. It's already on a farm that you existed. I suspect probably not, but,
Yeah,
but you can tell
new
me.
to you.
New to you.
New to you.
Yeah.
Yeah, the interesting piece about bonus and 170 deductions, both new and used property qualify for both provisions. That was made clear earlier after TCJA was passed. So this question is, I bought a farm that includes tile that was already there, existing tile on a farm purchase that's new to me, as long as I did not buy it from a related party, and that's true for both of these business provisions. Related party purchases are disallowed for these accelerated deductions. But if I bought a farm from Todd and it's got tile on it, then I can use the bonus deduction for it. I can use the 179 deduction for it too, as long as I meet all the other tests and criteria. There's lots of eligibility rules, lots of reasons that I might not be able to use these deductions. But if I'm otherwise eligible, that's a qualifying piece of property for both bonus and 179.
Because it's a piece of property, the age of the tile.
Age of the tile doesn't matter. It's new to me. It's the same as if I bought a used tractor from Todd. I'm buying used tile. It's eligible for both bonus and 179 because tile is 15-year property, eligible for both. Yeah, great question. I love seeing these pieces come up here for us to help kind of clarify what's happening. One more thing before I should have talked before I left that screen. The bonus provisions are pretty lumpy. So if I have $80,000 of breeding stock and $150,000 of equipment and let me give a different number, $60,000 of tile, I can use bonus deductions on all of that or on each segment of that. I have to use it on a class-by-class basis, so it's kind of lumpy. If I'm going to use the bonus on my breeding stock, I have to use bonus on $80,000. On the 179 deduction, I can pick any amount that I like. I can pick $100 of that deduction. I can pick $2.5 million of that deduction, or any number in between. Again, as long as I meet the other eligibility requirements, I have a very specific amount that I can use for 179, but for bonus, it's pretty lumpy. Everything in that class or none in that class. A few more business provisions effective for 2025, and we'll see also prior years. Qualified research and experimental expenditures. These are often called QREs. They're now fully deductible. Prior to the OB3, those had to be amortized over 5 years if they were purchased in 22, 23, 24, or 25. Now we have a very unique transition rule that for these years, 25 for sure, but also 22, 23, and 24, we can elect to not amortize those qualifying research expenses and instead fully deduct those amounts. Well, if I've already filed my 22, 3, or 4 tax return, I've already done that. I've probably deducted those research expenses already, and I get to keep doing that. But the cool thing about this is now I can go back and make an election to treat these as qualifying research expenses. I then can go look for a research and development tax credit, claim that credit, and not have to lose these deductions. That would have been true in 22, 3, and 4. I could have claimed a research and development credit, but the deductions that created that credit, I had to then take off of my Schedule F, could not deduct them in full, instead had to amortize those costs over 5 years. And that was not favorable for looking to take advantage of the R&D credit provisions because I lost such a big tax deduction and had to pay a really big tax up front. Now I would get that tax back over time, but the time value of that loss made it not that much fun to do. So now this is back. We have a transition rule for 22, 3, and 4. I get to keep the deductions, and I can look to see if I have a qualifying R&D credit application. I have to do that election by July 4th of 2026, which is 1 year from the enactment date. I have to have a taxpayer who has less than $31 million of gross receipts. That's averaged over 22, 23, and 24 to be able to apply this specific provision. And then if I do get an R&D credit, that I have to reduce my schedule of expenses by that amount. But now only by that amount. Previously to this passing, I also had to reduce my overall expenses by the total qualifying research expenses. So here's an example. If I had a $300,000 qualifying research expense under the old rules, I had to take that off of my Schedule F, raised my AGI by $300,000, and I got a little bit of that back by an amortization deduction. Essentially, I got 20% of that $300,000 deducted in 2024. Now I get to keep the $300,000 deduction, and then I can look forward to see to what extent does that generate any proper research and development credit for me. And let's say that R&D credit is $8,000. Now I only have to reduce my Schedule F expenses by that $8,000 amount. This will require amended returns if I choose to adopt this for 22, 23, and 24. My amended return for 22 has to be filed by April 15th of 2026. So we have a shorter leash on getting some of these things done. There's another unique provision effective July 4th of 2025. Have never seen something like this before for our farm operators. But if I have a farm qualified real estate loan, the bank who made that loan to me, they get a 25% deduction on the interest income they receive from me as the farm borrower. Refinancing loans before July 4th of 25 are not eligible for this payment or this benefit to the lender. It has to be real property that is the underlying loan asset, which is used to produce one or more ag products. And I can be a cash rent farmer, cash rent landlord, money borrowed against my land purchase. It will qualify for this reduction to the lender as long as my tenant was producing ag products on my property. This is my kind of guess of what I think it might be worth to a lender. Again, only loans made after July 4th, new loans made after July 4th. Let's say that loan had a 6% rate. This new provision means 1.5% of that is my tax deduction that the lender gets. Again, this is a provision for the banker to lower their tax liability on the interest income that the farmer is paying them. If the lender had a 30% tax rate and they have a tax deduction of 1.5%, that means they get a benefit of 45 basis points on that loan. Now, the benefit will vary by every individual borrower and every different bank, because these things have different meanings to each borrower as well as to each lender. But it's unique here that the lenders are getting a deduction for farm real estate loans that are paid by the individual. We move now to some things that start in 2026. This we've had for a while. This is the QBID, the Qualified Business Income Deduction. There was a provision that raised that from a 20% level to 23%. That did not stay in the final bill. The QBID remains at a 20% deduction. They added a new minimum QBID of $400, but you have to have at least $1,000 of net income to get that $400 benefit. And if I have a $2,000 QBID, then my deduction is $400 under the normal calculation. So it only benefits taxpayers who have $0 to $2,000. I guess I should say $1 to $2,000 of income. they have a new $400 minimum deduction. All the other rules stay the same. This has been a nice benefit to shield certain farm income away from fully being taxed. 20% of it is eligible for a new deduction. The estate tax exemption is bumped a little bit to $15 million. I say now for 2025, it's $13.99 million, beginning for deaths after December 31 of 25. It will be a $15 million federal estate tax exemption. For those of us in Illinois, we continue with a $4 million Illinois estate tax exemption, but the federal is bumped up a little bit to $15 million. Without this OB3 provision, that was projected to go back down into the $7 million range. And gladly, it's back up here now. Also permanent, again, whatever permanent fully means, at $15 million. I put this one in here for my kids, Jim. Was that all right to do? Both of my boys are coaches, and so they're also teachers, but teachers have been able to benefit from this $300 deduction. You have to meet certain criteria. You have to, be a teacher, be a principal, be a counselor, work 1,000 hours in the school, in a school year. And if you pay certain expenses that are not reimbursed, you get a $300 tax deduction. They added coaches to the definition of qualifying individuals to get this extra deduction. A couple more, Jim, then we'll get to some questions, Todd. Gambling losses only allowed at 90%. That used to be a 100%. So if I had a $5,000 gambling winning, I was able to also deduct $5,000 of gambling losses, only if I was itemizing my deductions. But now I will not get a full gambling loss allowed. Some of my gambling winnings will be taxed, even if I'm able to itemize. Those of us who are employed by other companies can have a higher dependent care flex account. That's up to $7,500. That means I can have the employer take $7,500 out of my paycheck. I can then get reimbursed my employer for dependent care, child care expenses, and that $7,500 is not taxable to me. Child care tax credit, if I choose to pay the child care of my own pocket, then I have a little higher limit on how much of that child care tax credit I can get. That had been a $1,200 maximum child care tax credit, and now it's a $3,000 maximum child care tax credit. So a couple of additional improvements for child care related expenses. Todd?
All right. So a couple of things. Did you know on the gambling loss that it was put into the One Big Beautiful Bill Act as an offset for the tax purposes in order to make it actually sound enough to go through?
Oh, I did not know
and that Las Vegas, the gamblers there are not happy about that. And they're already in the process of having it put through as a fix in the legislation.
Oh, really?
So something to keep an eye on.
Many of those will be coming.
Yes, they will. Yes, they will. So
I didn't want that part of the bill passed, right?
Yes, that's correct. Yes, that is correct. Okay, so a couple of things. You'll have to remind us of what these belong to. First question is, does the 25% deduction apply only to ag or commercial real estate as well?
Only to farmland upon which ag products were produced. So yes, if it's a commercial storage building, no. The 25% deduction only on farmland that has commercial or that has ag products produced.
The second question, and I thought about this when you were talking about the R&D expenses or the experimental expenses. Can you give an example of what would qualify for that tax credit? For instance, I don't think that if I were to run an experiment on my own field to see if fungicides actually worked or not, that would be something, but there probably are other things that you can come up with.
Yeah, that is the real key to what of those expenses qualify. And there's some debate among tax professionals and other tax consultants on what that is. Some think that's a very broad list, and some think it's a very narrow list. I mean, I have seen reports that say if I use different types of seed to measure productivity, that's a qualifying research and development expense. And I've seen some that says, well, that's great on Todd's test plot, but it doesn't really apply to Todd's 300-acre cornfield. Feed trials would be one that would count. Applying different types of genetics would be types of expenses that would count. We do know that if you're making purchases of equipment to try, that does not count as a qualifying R&D expense. But think about the labor provided, the supplies you might buy, the different things you might be doing to, guys, that's like a whole lengthy seminar to do. But what you're trying to do is through experimentation, remove uncertainty about how a certain process works. That's the broad statement.
Okay. We'll see how that gets put into place over time. Next, what if you have multiple businesses and they net a loss together, but one of them is actually profitable? Would you still get the minimum QBID?
Oh, great question. That QBID is eventually measured at the individual taxpayer level, and they're going to accumulate and combine all business activities that are QBID eligible into one overall QBID calculation. So if I have 3 losses in businesses 1, 2, 3, and a gain in business 4, we're going to push all of those together to determine if I get the minimum QBID or not. So I think they will get all combined at the taxpayer level.
Something you may address eventually here, but we have a question on it. Any chance that there's been a change in the gift tax limit?
Yeah, that has not changed. That was not included in the bills. That remains at $19,000 for the annual gift exclusion. I think that's what the question is about. We do have, by definition, a change in the lifetime gift exclusion. It's the same as the federal estate tax exclusion. So that had been $13.99 million. That did jump to $15 million, but that's for large lifetime gifts. The annual exclusion that people think about remains at $19,000, and it's indexed for inflation, so it might be a different number in 2026.
Okay, let's move forward.
We have some provisions also next year, these new Trump accounts. And guys, this is one that's going to take a lot of interpreting, a lot of FAQs. What does it really mean? And I have some things on the slide. I believe all these things are on my slide, Todd, but there's a lot of pieces that we're still trying to sort out. It works like a non-Roth IRA, except that it kind of works like a Roth IRA. And I'll explain that in a minute too. It's not a retirement account, it's a savings account, and only for individuals who are under age 18. A person can put up to $5,000 annually into that new type of account for an individual, and it's non-deductible by the person who puts it in. But here's where it kind of works like a Roth account. From that moment forward, the earnings in that account are never taxed unless they're used for a non-qualified distribution purpose. And it lists out what those things can be. But this money grows essentially tax-free. It can be used for distributions for these individuals well after their age 18. There's one unique piece that we just studied this again yesterday in some depth, and we had some debate. Is that really what it says? And I think it's what it says, that there can be a deductible contribution if it's made by the employer for the employee's dependents account. And up to $2,500 a year is the max. And I think this is the one instance where it appears that a Trump account could be a deductible contribution if it's through an employer plan. Now, that's really where it gets a little salty. Like, exactly what does that mean? Does the employer have to put $2,500 in for every full-time employee, only if the employee requests it? We're not sure exactly what the rules about that are going to be, and they're not written, and nobody knows what that is. But it does appear there is a chance to get a tax-deductible contribution if it's paid through an employer into this plan for young people to start them saving for the future. But it's kind of like an IRA, Todd, but not exactly like an IRA. And it's not really a Roth, but it acts like a Roth because the earnings can grow tax-free. Other provisions that start next year, charitable contributions are back even if you're not an itemizer. These have to be cash contributions paid to a qualifying 501c3 charity. So think about a church, a school foundation, some service organizations are 501c3 entities that can receive these contributions. It's $1,000 per person, $2,000 if it's a married couple. Those have been gone for a while. They came back a couple of years ago at, gosh, I think they were $300 and $600 limits, and now they're back at $1,000 and $2,000 limits, cash contributions only, and not until 2026. 1099-Ks are used to report amounts paid by third-party payers. So if I'm using any of these third-party credit card and other type of virtual payment platforms, those have to send a 1099-K saying they paid Bob $21,500 and he had 212 transactions for the year. The reason this is important is they were pushing those thresholds down to $600 and 10 transactions, I think was the number. And that was going to require a lot of reporting. Gladly, that never happened. We're back up to these much higher levels of $20,000 and 200. There will be a lot less 1099-Ks required to be issued. Similar to that, we have new rules about 1099 provisions. We have many of these that are required by our farmers to issue every year. Those have been, for my whole career, 41 years worth. If they had $600 or more of payments, you had to send a 1099. These are for cash rents. These are for interest. These are for non-employee compensation. These are for attorneys. A long list of people had to get these 1099s issued. And now that amount, for the first time in a long time, is increased to $2,000 before you have to issue people a 1099. This doesn't start, though, until payments made after December 31 of 25. So during 2025, we're still tracking payments to people for $600 threshold amounts. But next year, $2,000. This is another unique provision designed to assist farm families. The tax on farmland that's sold by a farmer to a farmer, that tax can now be paid in 4 equal future installments. So I have a land sale in 2026, and the tax on that sale is $100,000. I can pay 25 of that, $25,000 when I file my 26 return April 15th of 27. I can pay another $25,000 in April of 28 and 29 and 30. That's all that it does. It doesn't lower the tax. It doesn't defer the gain into later years. Whatever my tax amount is, I just can get an automatic installment payment plan without any interest. But it's not that good. Here's the problem. One of us is the problem. Here's the requirement. For that to be true, I, as a seller, have to get from Todd, my buyer, a covenant from him that says it can only be used for farming purposes for 10 years. Todd might not want to make that claim just so I get to pay my tax over 4 years. That's a pretty big covenant restriction on the buyer. And I think that's big enough that some people will say, it's not quite for me, because the benefit is only the time value of the tax liability. Trump accounts that qualify for single employee owner S corps. That's a really good question that the legislation does not address. It says employees. For most employee benefit provisions, a greater than 2% owner of an S corp can't use those benefit provisions. That would be my guess, but we don't know. We'll wait and see what the FAQs provide. There's just a few Farm Bill provisions to kind of wrap up our time here together. The tax provisions that are effective in 2025, The payment limit is now $155,000. That had been $125,000. And that's important because it involves how we select business entities, and it involves how we calculate certain provisions. The qualified pass-through entities can now get multiple limits. That's never been true. S corps and LLC partnerships formerly were only limited to one payment limit. And so often people thought that they needed an LLC to properly conduct their business activities. And for many cases, that was true. But one of the restrictions on making that entity choice was you had one payment limit for FSA provisions. Well, now that restriction is eliminated, and where only general partnerships used to be the only entity that could get multiple payment limits, now these S corps and limited liability company partnerships can get multiple payment limits too. That's a very significant change that will affect how farm families choose their entities for which they're farming their business, how they're conducting their farming businesses. And here's the other piece that affects tax return preparation. When 75% of the average gross income is from farming, there's no AGI limitation on getting a payment. We're just in the middle of this, trying to understand what this means right now. For the SDRP program, there is a form called a CCC 510 that has to be filed to say, my income, even though it's over $900,000, it's all from farming, or at least 75% is from farming. And then I can avoid the payment limitation. Or let me rephrase that, not the payment limitation. I can get a payment even though I'm a high income individual. And for SDRP, we don't use these rules. We only use these rules for the ECAP provisions and any future farm bill provisions. And these are much better. The 75% of gross income from farming is measured at a more favorable measurement, and farm equipment sales qualify as gross income from farming under these farm bill provisions effective for farm programs in 2025 and forward. The SDRP provisions that are currently being reviewed are not under these rules. They have a different measure of calculating income. Farm equipment sales only count as farm income if 2/3 of your income was from farming without farm equipment sales. The other piece that's here is I'm an enrolled agent that IRS has designated me as a professional certification. I can file the CCC related to the ECAP, but I cannot file the certification for the CCC regarding the 510 form in the SDRP program. So we're dealing with two sets of rules this summer, Todd, on which program are you in, how do we calculate gross income, and who can sign the certification, and what about farm equipment sales? Only for those from 25 forward do we get what I would call the more favorable treatment. Is the 75% rule allowed for an entity or a sub-S? Yes, that's measured at the entity level as well, and farm equipment sales are a part of that calculation, again, for the new rules for 25 and future programs. It's a lot of fun talking about OB3 and how that affects our farm families, Todd. FBFM and our staff are here to help people understand that better as we begin to find out more details that will come through notices, rules, regulations, and FAQs soon.
All right. Thank you much, Bob. We appreciate it, just as we appreciate those folks who sponsor these webinars. They include the TIA Center for Farmland Research here in Mumford Hall on the Urbana-Champaign campus of the University of Illinois, CoBank, Compeer Financial, Farm Credit Illinois, Illinois Corn Growers Association, the Illinois Soybean Association, Growmark, and of course, John Deere. Our partners include the College of Agricultural, Consumer, and Environmental Sciences, the Department of Agricultural and Consumer Economics, Illinois Extension, Gardner Agricultural Policy Program, and naturally, the FBFM, where you are
Yeah, look at that
part
logo.
of that.
Looks great
Yeah,
on there.
it is a great logo, isn't it? Behind the scenes today, we want to thank Jim Baltz, who is making sure that everything is running smoothly and that we get the questions up and answered as quickly as possible. Thanks to Jim, and of course to all the folks that have been helping throughout this process. If you want to see this again, you can always find it on the FarmDoc Daily website at farmdocdaily.illinois.edu. Look under the webinar section there, under the archives, or maybe more easily, you can go to youtube.com/@farmdoc. On behalf of Bob Ray, Jim Baltz, and myself, you have a great day. I'm Extensions Todd Gleason.